U.S. Steel reached 66, I think it was, or thereabouts, on January 11th. Since then, going into the end of the month, it dropped to $44. So it lost a third of its value in that short period of time. It's kind of one of those situations where when the market drops that rapidly, if you're on board, great. If you're not, it's kind of a hard one to chase. But I just want to point this out as one of the signs that there might be some potential underlying weakness. If U.S. Steel is not selling steel, and if their prospects are not selling steel, they are very good according to the officials there, what does that say about the economic outlook for this year? So you have some real negative things to, in terms of the economy in that regard. Now, the other, a couple of other markets that have gotten a lot of news about them lately as being hot markets. This one shows the China 25 index, the FXI, the Exchange Traded Fund. As you can see there, where I put my cursor, my line, you can see that we are at a situation that there is a potential for a breakdown in China's stock market. China is being touted as hyping up their numbers and feeding into the inflationary things, and now they're going to cut back on that, and they're going to cut back on spending. The reports of a lot of overbuilding. They built offices and stores and so forth that are not occupied. We don't know. I don't know everything about China, but it's a situation where when you have a situation like that where the chart is saying it is pointing down, potential sign of weakness, kind of a market to keep an eye on. Now there's another one that, that's kind of like the international picture where it looks weak, but there's another one that is kind of an interesting chart to look at with somewhat the same type of dynamics, and that is Apple. As you know, they've been selling all kinds of iPods, and they've introduced the iPad, and there's so many different things that are so many bullish about it. But when you look at what's going on there, and if you can see where the line is, where my cursor is, if it drops below the lows and gets below, like into the 180, 190 area and drops below those, maybe all the good news is market already. Maybe everybody's kind of bought the shares that they bought because they knew all this good news was coming out, and now the stock is starting to sink. You can't be sure with Apple. One of the things about Apple that you should be aware of, if you're not, is that we've had some daily ranges of $10 in this stock, and that's pretty rich as far as I'm concerned. So it's not a stock that I'm actively trading, potentially with options or something, but it's not a real good share. It's an expensive share, not a real good share for novices to be getting into. But as I say, the signs point to the possibility that all the good news may be in the market, and Apple could have a weak period, which could be the kind of the leading indicator for the whole technology side of the market having a weak year too. One can never point that out for sure, but that's just kind of what we look at for signs of what potentially could happen. We're going to skip back again to wrap up what we've been talking about in this particular, the January effect types of things, and what happens with different types of indicators, barometers, I guess you better call them, for January. And when we look at January, we have certain things that we do know. We don't know precisely all the prices, but when we do look at January, we do have some things that we do know, and that is that we are in a situation with economic uncertainty. We have a lot of reports of economic recovery taking place and things looking better, and then the next day we get a report that nope, things don't look so good. Housing isn't recovering. Other things are not recovering as much as expected. So you have very definitely a situation of uncertainty. For example, you get the, we got the gross domestic product numbers a few days ago. It indicated the fourth quarter GDP was up 5.7%, which was the best quarter since the third quarter of 2003. Very good, all that good. But when you look at the year as a whole, 2009 was minus 2.4%, which is the worst year overall since 1946. And so that's kind of the mixed message that you get from just looking at those numbers. Then you have the government stimulus. Is it going to end, and what will happen if it does end? Will there be some withdrawal pains? We still have the issues of jobs and spending, consumer spending, and there are many different things that are happening there that are not particularly positive overall for the market outlook, whether the January indicator says anything or not about it. So when you look at on the stimulus, when you look at some of the things that have come out, for example, when President Obama talks about his goal, we're going to double exports in 5 years. I don't know exactly how he plans to do that. Seems like to me anyway, a lot of political rhetoric, pie in the sky type of comment, and sometimes it seems that there's more hope there than believable, more hope and hype than help, I like to phrase it, but I don't want to get into all the political ramifications of things, but I definitely want to make sure that you are keeping that in mind when you're looking at the prospects for the post-January breakouts as to what might happen. A number of analysts also are still talking about the one market theme, that all markets, and as you saw in some of the charts, when you see the E-mini going down and you see other markets going down, the counter to that, of course, is the U.S. dollar. When you see the U.S. dollar now rising, it is quite possible that the low for the year is in place for the U.S. dollar index. And of course, by the same token, that would suggest that the high for the year is in place for the euro. Again, you have to watch to see what happens in the future, but those are the types of conclusions that you might come to when you look at that first 2 weeks of the year barometer that we mentioned earlier. If you want, if you want to take a look at the markets, and it's a little different way maybe to take a look at it, keep in mind where you can trade the breakouts of the January price ranges. By trading the breakouts of the January price ranges, it's kind of like the channel breakouts that we use with the predicted highs and lows and vantage point. It gives you a definite point at which to take action and to get yourself into a position. At this point, of course, as I said, the major U.S. indexes have, indicated with their January action, they had an outside month reversal down. If nothing else, it's pretty much a sign of a topping formation, and it's not likely that the stock market will see new highs in 2010 as they did earlier. And it could potentially be a situation where it leads to large losses. Again, unknown, but those are the kind of things that you have to look at, and that's why you need to use some trading tools like Vantage Point to know when to trade the breakouts and where to trade the breakouts, and to refine what you want to do in the market. Don't know if there's any questions. I have a slide here that kind of, if you have any questions about Vantage Point and its forecast, the information is on the screen. If you have any questions related to any of the markets that I talked about, or any other questions about, the January breakout and how it might affect